Welcome to Value Research Live. Today we are decoding SIFs, the Specialized Investment Funds. SEBI has enabled these new vehicle with a framework. By their design, SIFs are somewhere between mutual funds and PMS. They have the flexibility to enable complex strategy. These funds can short sell, but with a higher entry ticket than a mutual fund. And this won't be a one-off. To track how these strategies evolve and how they perform in the real markets, we'll hold this roundtable more often with the leading SIF managers. Our job in next about half hour is very simple. What these new SIF launches are trying to solve, how the long short piece actually works in plain English. We have been listening about it, but how do naive investors decode this? And who should consider them? And who should stay away? So joining me in this SIF roundtable is Sandeep Tandon, founder and CIO of Quant Mutual Fund, Jatinder Pal Singh, CEO, ITI Asset Management, Bhavesh Jain, co-head Factor Investing at Edelweiss Mutual Fund, and Gaurav Mehta, head of SIF Equity at SBI Mutual Fund. First and foremost, Jatinder, tell me, if you have to explain SIF to a smart investor who has never heard of this term, what is it? What gap it fills?
Sure. I think a wonderful question in context of the part that SIFs are getting launched is a new terminology, and there may be some complexity because these are new words. So let me first reassure everyone by saying, like 25, 27 years back, when we came to the industry, same thing was being told about mutual funds. People had to learn, debt funds and equity funds, the asset classes, and what NAVs, how they work, and so on. And then came the exams. You remember this is about 23, 24, 25 years back. So what I have learned is that in the last 6, 8 months, when February, March, when the SIF came in, terminologies are new, but it is just matter of learning, adoption. The way we have grown ourselves in the mutual fund industry, taking the industry to 80 lakh crore, same base will be set up in SIF. So while SIF, the full form from the regulator is Specialized Investment Funds, I would like to also say you can even say these are systematic investment frameworks set wherein till now, whether you think about mutual funds, you talk about PMS, or you may say even AIFs, alternate funds, more than 99% of the money is in longs, which means no leverage can be done. Taking the benefit by going against the market in case you think for any reason an alpha can be created or a portfolio downside can be taken care of where the opportunity arises, which today, because of various reasons or habits, it is not possible. So both sides of the markets can be taken benefit for the investor. At the same time, let this not, a lot of people are confusing this with, is it trading? Is it speculative? The answer is clearly no. Rather, I think there is more science in managing this. And what I have learned from the countries where, these kinds of fund, long short funds or hedge funds are already available, is this that rather they are more risk aware. So this is a smart risk management tool which is coming to the market. So let everybody learn it. There's no hurry. It is not that it needs to be done overnight, but the faster the better. So simply you can take positions in the both sides of the market. Long, naturally you are allowed. But even if market looks for whatever reason, look that there can be a correction, and or in a stock position there can be a value creation or a alpha can be created. Today SIFs allow up to 25% positions in that.
So, Sandeep, I come to you. What has been, you have been most excited about this. When you say long short in SIF, what exactly are you doing differently?
When we talk about SIF as a product, what SEBI has actually offered us, they have given us a tool. It's up to us whether we want to use this tool or weapon in a more aggressive manner, or we want to use this in a conservative manner where you try to protect your downside and reduce the volatility of the portfolio or the beta of the portfolio. We call it as beta management product because we can manage it better. So it's up to us how we manage. And if you look at whatever initial phases, we have seen the entire industry, all the mutual fund who were launched the product, they have launched this product on a more on the conservative side. Okay, so that's the approach we have taken. The way I define this product, not to look at this product in isolation, because this question comes to us from various investors, and this is a big confusion whether should I move out from mutual move to SIF. So what we are trying to say, if somebody has next 5 years perspective, so we say next 5 years, you should have 50% mutual fund and you should have 50% SIF type portfolio so that it achieves three things. First of all, the combined portfolio, the volatility comes down. Okay, the drawdowns are the lower on the combined portfolio, and it also gives you a unique offer opportunity to generate alpha by shorting also. So there are three
Mm-hmm.
advantages which you can play, and that's the reason your portfolio is more balanced. If you look at the combination, it's not skewed. So let's say in a risk on period, your mutual fund product will outperform the SIR product. And a risk off period and volatile period, or the, if I have to say, bearish phase, these are the product will outperform the other mutual fund schemes. So that's the way the
Mm-hmm.
combination approach will give you a better balanced product rather than just looking this product in isolation. Even somebody is looking in isolation, then I will say statically these products are less risky as compared to mutual fund schemes.
Sandeep, if I have to ask you, what is the primary objective of shorting via with derivatives? The real purpose: downside control, alpha, or smoother returns?
I will say combination. See,
All the three. Okay.
yeah, in a combination, because in India, when we talk about the word shorting, okay, shorting is more associated with hedging. Okay, I have already have my portfolio, so I'm going to hedge. Shorting to generate alpha is not the thought process, except few HNI and few trader who look from this perspective. But broadly, thesis about shorting is linked with the hedging. Here in the SIF, the edge comes over because the money manager or the research analyst can identify these extreme inflection points in the market. Let's say if I'm long TCS and we say something is not right for us from the Infosys, I'm giving you just for the explanation phase that
Mm.
I have option
Sure.
to short Infosys without owning that. That's the
Okay.
reason we call it naked short position. Regulatory has defined this as unhedged position,
Understood.
but it's a naked short. The advantage
Mm-hmm.
is obviously from a risk perspective. See, derivative is a very unique instrument. A lot of people say the moment say derivative means people think more risk. Actually, derivative is
Mm-hmm.
a tool which gives you a better risk management tool. Since there is no leverage, the moment you add
Mm-hmm.
leverage along with the derivative position, then becomes more risky. Where regulator is very
Mm-hmm.
clear, we are not allowed to have any exposure more than 100%, which means effectively no leverage position. So that means you can only use from a hedging perspective or alpha generation perspective, more from a beta management rather than creating a leverage position on that.
Gaurav, I have this question for you. Name two risk investor underestimate in this long shot. One market risk, one implementation risk.
Right. So I think, first of all, talking about the market risk, Virendra, when you think of long, when you think of short, you're doing something on the long side, you're going unhedged shorts on some other stocks. It doesn't necessarily mean that, you can't lose money on both legs. So to that extent, just using derivatives doesn't necessarily mean that you are only mitigating risk. It can sometimes enhance risk as well. I think that's something that investors will have to be wary about. And that's something that, every product will have a very clearly laid out strategy on how they're using derivatives and so on, especially when using options, for example, right? If you're shorting options, it's a very non-linear risk instrument, right? It can hurt you in several ways with limited gains, unlimited risk. So I think to that extent, derivatives is a two-edged sword where it can hurt you both. It can help you, it can hurt you. So I think just using derivatives doesn't mean you're necessarily reducing the risk of the portfolio. Sometimes you can be enhancing the risk of the portfolio as well. I think that's something to be
Very
cognizant
often.
about when sort of thinking about derivatives
Mm-hmm.
and long short in general as a strategy, because your longs can go wrong and your shorts can go wrong at the same time. The second risk, when it comes to, let's say, talking about the execution risk or, risk apart from the market risk, operational risk, so to speak, is that, again, derivatives have a different construct versus, usual cash only funds, because here you have to make sure that you have sufficient margins to take care of any MTMs, any exposure margin requirements for the derivatives. So I think those are some nuances that you have to manage, which is over and above what a conventional long only fund does. For example, if you're dealing with stock options in India are physically settled, right? So do you have the sufficient collateral to give as delivery if need be? So I think those are some risks that the portfolio manager has to be aware of. And I think this in some shape and form was also playing in the regulator's mind that given the non-linearities and different aspects of risks associated with derivatives, and given the sharp increase in retail interest in derivatives, is that something that's best left in the hands of individual investors, or should it be done in a professional environment with sufficient railguards from a regulatory standpoint in place? And I think that is what led to the introduction of SIFs, and the hope is that that professional portfolio managers will be able to manage all these risks more efficiently.
So what do you have? You have net exposure bands, stop loss discipline, or have you created, or position limits? Have you created all this for your SIA?
Right, so I think the first guardrail is the regulatory guardrail, right? Where the regulator has said that you cannot go beyond 100% of your gross assets in terms of exposure. So in a way, they've said that no leverage is allowed. I think that automatically limits risk to some extent versus a levered product like an AIF. Secondly, I think within each category, the regulator is very clearly laid out on what you can do and what you cannot. For example, while shorts are allowed across categories, they said that unhedged shorts cannot be beyond 25%. Similarly, when you're using options, when you're selling options, which is an unlimited risk trade, the entire notional exposure gets counted as exposure. And again, you can't exceed 100% of your exposure. So to that extent, the regulator has tried to put in a lot of guardrails to make sure that this doesn't become unconstrained risk product. But secondly, I think as asset managers devise their own individual strategies, they are putting certain guardrails as well. For example, in the product that we have come out with, we're using options as a way to mitigate risk, not enhance risk. So we're buying protection against all our stock positions and so on. So to that extent, more than the stop loss limits, it's the inherent options bands that we're using. For example, we are buying put options against most of our equity exposure, which helps automatically define a stop loss on our existing positions. So I think those are some guardrails that are working on a strategy level. Apart from that, the usual guardrails around diversification, position sizing, and all of that, in any case apply. So I think that combination of strategy level guardrails and the regulatory guardrails make sure that SIFs, while it's a great start with respect to providing more flexibility on the use of derivatives versus mutual funds, doesn't become a very uncontrolled, unconstrained risk product. So I think from that point of view, investors should be assured that enough and more attention has been put in place, both from a regulatory point of view as well as from the various asset management companies with respect to the underlying products.
So it's not going to be nasty for investors in the worst case. Bhavesh, I have one question which ideally for which I have to look for the answer at value research. That is what we do. How should an investor judge success of these SIS?
See, I think the first thing is you have to think SIF like any other mutual fund scheme. And that's why whenever you evaluate performance of any SIF strategy, it has to be looked upon like how you evaluate any mutual fund schemes. Normally, for you can say a fixed income oriented strategy or a low risk strategy, I think at least 1 year is the minimum you should look at. And any equity oriented strategy, it has to be looked upon at least from a 24 to 36-month lens. See, most of these strategies will actually be replicating or in a way trying to replace some of the existing fund, either on mutual fund side or on PMS or on AIF platform. So that is the category where we will be competing. And that is why I think relative performance to some of the existing product will definitely be a way to evaluate this fund. But at least you should give, you can say, reasonable time like you give to an equity mutual fund or a fixed income mutual fund scheme in that same balance.
So we should be looking at, or we should be evaluating on at least a 5-year plus time frame for an equity fund or a long short fund.
Not for a long short. See, long short will be more of an absolute return strategy. That will be more, you can say, in a way, will be compared with arbitrage or you can say an equity saving fund. But when it comes to an X top 100 strategy, that will be like a mid cap fund or a small cap fund. That has to be, you can say, evaluated over at least a 3-year time frame.
So we'll have to be careful while benchmarking them that what are we comparing against. Okay,
Yes.
now that we have set the context, I will come back to all of you individually. First, Jatinder, uh, your first product choice. As a first SIF product, you start with equity long short.
Sure.
Why not simpler allocator or fixed income long short?
Another very interesting question. Actually, if you ask me, it comes from two contexts. One, at our group level, we have a AF license and we have been managing the directional equity long short fund for about now that's 7 8 years.
Okay.
So it's a very natural progression for us. Our CIO has been in the long short market for almost 2 decades now. All four of us who are here on this platform, we were in the first batch. Give few days here and there to get the approval from SEBI on this. And very frankly, few things each one of us learning little later. And secondly, when we were preparing, we thought a perfect way of showcasing the process we are setting up, the expertise what we have would maybe come more from the equity long short. Each one of us our own skill sets, and accordingly we are utilizing that. The way we are formulated and managed before historically, though I can't say it is exactly same because the leverages are allowed out there, but within the regulations that have been set up, we set up the product processes, the governances, the transparencies that we wanted. And so that is why we thought that maybe we thought this should be the first step towards the towards as a launch strategy.
Jatinder, I have a follow-up just to understand it a little closely. If you have to prioritize the investor's pain point, the drawdown control or a smoother journey or differentiated alpha, which of these what will be the order of priority with this fund? Drawdown, smoother journey, or differentiated alpha?
I would first go with drawdown.
Okay.
Though I know if you ask somebody from a team, the answer may differ, but I would go with drawdown. And the reason comes from the part that if you manage the drawdown, whenever that hits, so you have already done maybe 50% of the job. So if 100 goes to 80 and you have gone maybe lesser than that, let's say, for example, you have managed at maybe 90 and 100, then when the market recovers, automatically you may start with a part that you can do better. Secondly, if you manage that, then you can create alpha also from there. And thirdly, if you manage that, we think automatically the journey becomes smoother because the beta comes down. Now the risk to this is there's a word called asymmetric return profile for this product, and this especially applies to directional equity long shorts. Right? Though I think only two of them have been launched till now. Now, within directional equity long short, you can do a participation upside, but we keep an equal eye on risk. So you have to take a position before early position, and what we believe is there are early enough signals out there. So things can be debatable, but I believe that if the level of drawdowns can be managed, everything else can be can complement that.
As you were saying that the focus is going to be on managing drawdowns and the downside protection. Tell me, what is the non-negotiable rules that you have phrased for this, the process and governance? Like, what are the explicit guardrails you'll communicate to investors that these are the things you will never do?
This is like a filter box where it is a responsibility lies at the manufacturing level to see that we filter out risk, and your risk can change phase over a period of time. When we are shorting single security, we are keeping a range between 1 to 4%. Now, one may look very less but it depends upon the stock and the liquidity itself. So now these numbers are in range for the time being. And at the same time, since we are in the equity long short, though some people are calling it flexi cap, we think that we are cognizant of the fact that not more than I think about 230 stocks are there in the F1 segment. So if I have to we to hedge portfolio and we use more of futures, so if I have to hedge that, liquidity in that beyond 120, 140, maybe 130, 140 goes down. So primarily what we have been telling that maybe you consider us today more like a large mid cap. We have to, and since the portfolio maybe depending on the AUM may not be very high in number of stocks, we are keeping both things in our mind, liquidity and the F&O part where we're to hedge. Because we want to be fleet-footed in this, and it is not about being there for the last mile returns. It is more to say that how I can manage this and be more proactive before time. It is the philosophy of the fund itself. In the long fund, people are getting attached to, uh, benchmarks and sometimes with peer group, and they are saying we will manage risk, but maybe with low beta high or high beta stocks, and we may not go into cash. So out
Okay.
here, when the clear strategy is about protection and participation, and then some limits internally, which fund managers and CIO are keeping between, depending on the monthly movement of portfolio vis-a-vis market movements, and some stop losses, especially in case of short positions, take a short position, especially in those cases. So they have their setup out there internally, and we are not attaching an absolute number because they are moving numbers, but they are being on, and it is not on a weekly or monthly basis. It's like virtually, it's like real time market that you are managing in.
Sandeep, you were the most excited when these regulations came about, which enabled these SIFs. And now you have a pair of them. The QSIF long short launches your brand. How do you differentiate? Equity long short as a phrase everyone is using, but in your funds, where does the edge actually come from? Stock selection on the long book, construction on the short book, or net exposure management timing, or what you have done in mutual funds so far, your experience, how you are able to leverage it here too.
So, Dhirendra, frankly speaking, stock selection in long short is a very vital. Okay, risk management is important. Managing gross or net exposure is also important. But I think what will make a differential is all about how well you do a stock selection, both on the long side as well as short side. Risk exists both on the long as well as short side. You have a risk of underperformance or going wrong on the both the side is possible. Answer is yes. That's the reason what we are talking about in this product. We are very clearly, we are not talking about this portfolio as a long-term portfolio. We try to identify these inflection points, extreme inflection points. So we have created our own high-frequency analytics through Markov model. We are trying to create these inflection points, extreme inflection points. I'll be seller and extreme inflection points I'll be buyer. And we are clearly looking for a short-term opportunity. So I'm not talking about rolling my short position over month on month or quarter on quarter. It will be few days or few weeks trade. Our idea of QSIP is not about absolute return product. We are looking this as a additional tool of shorting, not only to protect my downside, but also generate alpha out of it. Shutting short or protecting my downside is available in the mutual fund. But creating alpha through shorting route is not available in mutual fund. And that is something we want to capitalize on this opportunity. We remain very confident that this product has actually potential to outperform the mutual fund growth. If you ask me, there in my personal view, let me give you, we have done some work on global basis and base our thing. We have written our coffee table book also. We think in next 10 years, a SIF type product will be 50% of the mutual fund active product. It's a very bold and big statement. Okay. So that's a level of confidence because we have seen when it picks up, it will picks up like a different thing. No, everybody wants to just suddenly decided to sit. Let's say 3 years track record industry is able to build. After 3 years, then people realize this is a better product in terms of generating superior risk adjusted. I'm not talking about this is the product is not meant for who's just looking for absolute returns. This product is definitely not for them. If somebody start looking for a risk and risk adjusted return, if we started looking at it, then this is a great product. And I think good amount of money will shift. But again, we have to wait and give us time for 3 years for the industry also, how it shapes up. And then you see this magic.
You have also launched a equity X top 100 long short strategy, what you are referring to. Why deliberately go beyond top 100? What inefficiency are you targeting? And
First of all,
how big a threat is a liquidity crisis or becoming a story?
So Dhirendra, today, let's say, we have to also look at this, whatever corpus we have raised is very tiny, minuscule. Okay. We also have to look at from the industry perspective, I'm not saying that we will only grow and industry will not grow and market. As we will grow, the depth and the breadth of the capital market is also going to grow. New and new stocks will be introduced in the derivatives and new IPOs will come. So if you ask me my personal vision, and when we're talking to the regulator and we do give this feedback, we think in next 2 to 3 years time, the basket of derivative stock will expand to BSE 500 or NSE 500. Then by default, market becomes very liquid. I'll give you a very small example. When we did the first trade and derivative way back in 2000 when it started, I've been associated in derivative for earlier stages. And if you compare the Cipla impact cost or Grasim impact cost, I'm talking about the large cap and the indices stock. It was very tough task to buy 550,000 of Grasim or 50,000 shares of Cipla. Today, if you
Okay.
compare 2000 and current impact cost of Cipla or Grasim, live example, is significantly low. Within fraction of minute, you can sell 50,000 shares, okay? Or fraction of seconds sometime in the derivative market. So what is important to look at? Today we have 100, whatever, 210 or something stocks in the derivative list, which is good enough to start. I'm not saying this is a perfect thing, but as we grow, I think regulator will also understand they need to introduce more and more stock in the F&O as we grow.
So we have reasonable depth to carry on.
Yeah, with this amount, and even let's say if it becomes few times or 100 times also is not a problem. The problem start when this go in isolation, market doesn't grow, which is never going to happen.
Moving to Bhavesh, your Altiva SIF, hybrid long short. What's the deal? In a hybrid short, what is the heavy lifting you do here? Carry the debt, equity selection, or the hedge?
So, see, as a manufacturer, normally what our, you can say, as a manufacturer, as a responsible manufacturer, what our, you can say, objective is, we do not want to, you can say, in a way, push our view over the market. What we think that as a manufacturer, we should have all kind of product because different client will have different need. And then because SIF is a new thing, we wanted to play to our strength and see for, you can say, particularly today, the reason why we choose to launch a hybrid long short fund first rather than launching an equity long short or an X top 100 long short is I would be happy to launch a X top 100 long short or an equity long short fund when markets are going through an euphoria. And we can, you can say, manage volatility using, I can say, hedging model in balance advantage fund. Like in COVID, for the markets were down 40%, our balance advantage fund was down 14% compared to the average of almost 25. So we already have this kind of product available on mutual fund platform. Now, the first, what is the demand from the industry? See, today you will see after debt taxation changes, a maximum flows of last 10 years have gone into two set of product. On one side, those who were wanted to have higher risk appetite, we saw substantial growth in small cap and mid cap. But at the same time, because fixed income alternatives were also missing, another set of highest flow has gone into hybrid products. So we thought that there is a huge demand for this kind of product also. And that clearly shows as HNI, ultra HNI family offices grow their wealth substantially, capital preservation is more important rather than chasing higher return. And that is where we thought that this is an appropriate strategy to launch. Now, Altiva Hybrid Long Short Fund, the strategy what we are running is combination of arbitrage and fixed income. This is two things we anyways do in our arbitrage fund. In addition to that, we have added two more buckets. One is special situation and second is all these new derivative strategies. Again, as I said, we wanted to play to our strength. We have been doing all these special situation trade and Edelweiss as a group is more, you can say, popular for doing this kind of activities since last almost 20 odd years. In a way, we feel that if without, you can say, adding volatility or without taking substantial risk, if I can get 2 to 3% extra return, then why to do all the, you can say, hard work of selecting stock, selecting sector, and finally, again, depending on where the market will be, my portfolio can outperform or underperform. I don't want to take that kind of risk for a hybrid kind of strategy. For that, I have my mid cap fund, small cap fund, and again, I'm sure we will have our X top 100 long short and equity long short also. This is nothing new. We are doing it in our existing hybrid fund like equity saving fund, balance advantage fund, and aggressive hybrid fund. And if you look at the track record of all our hybrid funds within the category, most of them have done a reasonable job with much lower volatility. We have to just club them together and play to our strength. And I think the initial success we have shown is, though 45 days is too small a period to, you can say, in a way, judge any performance. But I think at least the initial success is as per our expectation. And that strategy where you can say if we are able to deliver arbitrage plus 2 to 3% return continuously.
What you said that, it is off to a good start, and what is the expectation that you are setting? What is the most common misplaced expectation you are already seeing? People thinking that it is FD plus, or, if people thinking that it is equity with guaranteed protection. How much of a, risk is that, or in terms of people having this perception or investors having this understanding?
Yes, I think see, definitely that is the most important thing, that if you want to run a product which is using derivative and derivative spreads, sometime are, you can say, not in your control, depending on market volatility, spreads, whether it is arbitrage spreads or covered call spreads, can go up and down. And that's why what are you can say in a way thought process always have been that we don't want to have, you can say, though there was an option for us to have a 1 year taxation, but that would have, you can say, in a way curtailed our flexibility. So we thought that better to have a flexible product. Don't worry about taxation, because we are not, you can say, in a way trying to play pure tax arbitrage. But if that, you can say, having 2 year kind of lock in a way lock in, because taxation up to 2 years will be as per your slab rate. And after 2 years, it will be 12.5% and education cess and everything. So that gives the fund manager a lot of flexibility, particularly in volatile environment, because that is where all this option writing and whether it is, you can say, naked short and naked long and pair trade and everything will become a tricky situation. So that time we can definitely increase our fixed income allocation and have that protection. So that is what our communication to the, you can say, all the clients have been, that don't expect it will be like an arbitrage fund where every month you will get 50 basis point or 60 basis point returns, because through covered call, through straddle stangle, in a way you are also having some market exposure, and that's why in short term your volatility can be higher compared to an arbitrage fund. The most important thing what we wanted to communicate from our end, that don't look like it an, you can say, monthly product, look it from a long-term orientation, and that's why taxation-wise we are at 2 years.
Coming to you, Gaurav, why multi-asset first? Though I know the answer, but you can explain it once again as it started rolling. You have positioned this as a long short, as a multi-asset approach, equity, fixed income, derivatives, even REITs and InvITs. So why start this as the front door for SIF investors?
Right, Dhirendra. So, obviously we had a lot of choices in terms of categories. SEBI has allowed us 7 choices overall, right? Our simple thought process was that where is the biggest gap in the market with respect to current slew of products? There are a lot of products that offer aggressive risk reward. There are a lot of products that offer complete stability, especially, fixed income mutual funds and arbitrage and so on. And then in between, there is a category called hybrid mutual funds, right? Which is a combination of debt and equity and in some cases multi-asset. However, when you look at fixed income and arbitrage on one end, which is supposedly low risk, let's not talk about the tax efficiencies so far, but from a return point of view, they are low risk, low return products. And then when you think of hybrid mutual funds, something like balanced advantage fund or equity savings or aggressive hybrid and so on, that we thought was proving to be a big step for people to climb, because someone who's used to the safety of arbitrage or fixed income cannot directly move to a product which will carry 40-50% unhedged equity exposure, because it comes with its own degree of volatility. I think Bhavesh talked about how balance advantage funds also fell 20-25% during COVID, right? I think it's not an easy step for people to climb. So we thought this was a big gap. And I think this gap got accentuated 2.5 years ago when debt taxation changed. Because at that point, people were playing debt as a way to, easily beat inflation with tax efficiency and so on. But that is no more a choice. So we thought this was a big gap, and you need something in between where you should get much more respectable returns than you get from an arbitrage fund. It will entail taking some degree of variability, but not as high variability as you get from uncovered equity exposure on hybrid mutual funds. And if it can come with tax efficiency, so much the better. And which is why we started with this category, because here we thought that we can have a risk reward proposition which offers significantly better returns than arbitrage, with slightly higher variability through a good use of options and derivatives. And at the same time, in this hybrid long short category, you're free to choose how much of equity or debt exposure you want. All you have to do is to maintain minimum 25% in both. So we thought that if we can have a higher allocation towards equities, control that risk through use of derivatives, then we can not only achieve higher stability or low variability, but also achieve equity taxation, and at the same time adding to returns from arbitrage. So that was the simple thought process. And hybrid in general is a category that people associate with low risk, right? So if you want to take risk, if you want to be aggressive, there are several other categories to do that. So we
Yeah.
thought this is a big product gap. This is a big risk reward gap in the ladder of risk reward spectrum. So we thought let's capitalize on this first, given the flexibilities that SIFs offer. And I think SIFs are not just about that 25% unhedged short exposure. SIFs are also about a lot of flexibility that they offer on the use of options, which today is very restrictive on mutual funds. So we thought let's
Okay.
bring all of this together to create a risk reward proposition, which is clearly absent in the markets today in a tax efficient fashion.
So in your design, what kind of drawdown reduction versus equity should investors realistically expect today?
Right. So in our construct, there are three components to return. 1/3 of it comes from debt and REITs and MITs. The remaining 2/3 is equity, of which one portion comes from options premium, and one portion is obviously within a band, some directional linkage to the underlying equity movement. Again, the construct is such that if an investor understands what's happening within it, I think they will not have to worry about what this construct looks like 3 months later, 3 years later, 3 decades later, right? This is not a black box construct. There's a degree of consistency to how this will be managed. And to that extent, these rail guards are inbuilt through use of options. So I don't have to necessarily take a very strong view on what market direction, will Nifty take over the next 3 months, 9 months, 12 months. So we wanted something which is more evergreen, which is easy for people to understand, and which is much more consistent across cycles. Now, with these three components of returns, again, only 1.5 months of live experience, so nothing to talk about there. But again, if I go back in history, and we did obviously some backtests, some simulations, and so on, and our sort of experience from the backtest suggests that you should be looking at something closer to mid-single digit kind of drawdowns,
Okay.
which let's say for a long only equity product were in the range of 40%. And Nifty was down 40%, let's say, during COVID. So that's the attempt, and that's the degree of variability that we're talking about, that if you can have mid-single digit kind of drawdowns and yet generate much more respectable returns than arbitrage, and bridge that big gap that exists between arbitrage fixed income on one side and average on the other side, then why not do that?
Now I'm coming to a brief question answer session where you have to answer it in as few a word, and I'll come to each of you individually. Coming to you, Jatinder, your fund, this is for one line, the ideal investor profile.
Aggressive investor can balance out by investing here so that it will balance the portfolio on the and for a conservative investor, this will balance upside.
Okay. Who it is not for? Who should stay away?
Any distributor or investor who's not prepared to upgrade the knowledge about these products should stay away till they really learn about this.
One thing to watch out for, which single number or disclosure should investors track every quarter in this fund?
Risk-adjusted returns.
Okay. Sandeep, to you too.
Yeah.
This is for whom? One liner, the ideal investor profile.
This is for type of investor looking for stable return with lower volatility.
I was thinking that, the same investor who is looking for or tend to expect ballistic return from quant.
It's actually, this product is not meant. That's the perceived perception about this product,
Yeah. Who it is not for? This is not for who should stay away.
Who are looking for extraordinary or supernormal profit gains from this product. It's not meant for them. It's meant for more conservative investor.
What we should be watchful about, any single number?
Maybe risk-adjusted return, maybe Sharpe ratio. One single number, good enough to get a perspective.
Good. Okay. For you too, Gaurav, this is for whom?
So I would think that all investors have certain allocations where they want to beat inflation comfortably with low degree of variability. So for a conservative investor, it's a bigger pie. For an aggressive investor, it's a smaller pie. But I think whoever wants to do that, it's for that entire set of investors.
Who should not invest?
I think I will agree with my co-panelists here. A lot of people think of derivatives as use a loose term lottery tickets. This is definitely not that.
One thing to be watchful about in your fund.
Well, I think A, staying true to the communication on what the strategy is, B, measuring the risk reward, and C, looking at the suitability of it from a portfolio diversification point of view on how uncorrelated or low correlated it is to your existing strategies.
Bhavesh,
Yeah.
same set of questions. Who is your fund for? One line.
For
Ideal
all,
investor.
so see, each client have a, you can say, a low risk portfolio, either in the form of debt or arbitrage or hybrid. I think for anyone who is happy with, you can say, post-tax arbitrage plus couple of percentage, I think this is for those investor.
Who should not invest?
And so again, anyone who is, you can say, expecting market plus or Nifty plus or any benchmark plus kind of return like Nifty plus 5 or mid cap plus 2 or 1, whatever that number, it is not a market linked product. So it is an absolute return strategy. So all those market linked investors, this is not a product for them.
Which number we should look at to be careful about your funds?
I think number of negative quarters, what we will have, that is something one should always track because that will show the real risk we carry in this portfolio.
So thank you very much for your valued time here. And the conclusion I'm getting is that SIFs are not a replacement for the mutual fund. They're a specialized tool. The right way to think about them is that they can improve the overall portfolio journey, net of complexity. And let's hope for the best. All of you have been off to a good start and wish you very best with your journey here. We'll keep coming back to you often to take stock of how things are progressing. Thank you.
Thank you. Thanks for the opportunity.
Thank you. Thank you.
Thanks, everybody. See
Thanks,
you guys.
Thank you.
Bye.
Thank you, Sandeep.
Bye.
Bye.
Bye.